City Investment Research, I cover ESG or sustainability issues more broadly. I've tended to focus on specific topics and dig into them with a bit of depth. So I've done a lot of work on carbon and climate change, some work on water, did a report recently on trends in vehicles, electric vehicles and so on, and I've done 4 pieces of work in the last couple of years on safety. And that's the report or the work that I'll talk about this afternoon. So why might investors care about safety when it comes to looking at listed equities, which is the area that I'm working in? Well, one aspect is that safety can be a window on management quality, and companies that address safety well often will address a variety of other issues well and will be sort of tightly managed and focused. Safety incidents can cost in terms of production disruption, operational disruptions and so on. It might be small, it might be big. Safety performance influences workers' compensation costs. Safety performance contributes to a company's reputation and its license to operate, things like its relationship with governments. Some employees prefer to work with a company with a good safety record. Heard anecdotally, I'll talk a bit later about a safety seminar we organised, but heard anecdotally of somebody leaving one of the companies that did actually do safety very well to go somewhere else and came back fairly quickly to the original company, figuring that he'd prefer to work somewhere that had a good approach to safety. It can influence business relationships, things like contractor-client relationships. And another aspect which I will talk about a bit but doesn't show up in injury statistics is the risk of major plant incidents, things that come under a heading of process risk, and there are some interesting observations there. So yes, safety performance may affect company performance, may affect profitability and so on, but the other thing also is that with increasing numbers of funds taking a responsible ownership approach or active ownership approach, signing up to things like the UNPRI, investors are increasingly taking more interest in how companies that they invest in behave, and safety would be one of the things that comes under that sort of heading. The research that we've done, we did 4 reports and we've held 1 safety seminar. I did a report in 2008 looking at safety stats and whether I could find a correlation with share price. In May this year, did some work looking at some safety incidents specific to BHP and Leighton Contracting in the Pilbara. Followed that fairly shortly with an overview of the ASX 100 companies looking at safety data. And then as a follow-up for that report, which looked at numbers but didn't really go anecdotally behind the issues, held a safety seminar and wrote a report on that, and that broadened the debate out quite widely. This work, it's been a catalyst for investor awareness, helped our clients, some of our clients with engagement with companies. It also, and I'll talk through this a bit more, really has increased dialogue between companies and within industry. And I'll give you some examples of that, but I think it's really contributing to this sort of responsible ownership agenda in a sense of lifting the bar and companies taking note of it. And I believe we're already contributing to improved reporting by companies. So the first work that I did was looking at lost time injury rates and fatalities across the ASX 100 and looked at share price performance over a 3-year period. When we just took the raw data, and this was a fairly simple study, we did find a tentative link that companies with lower injury rates and so on tended to have better share price performance. But then, sort of being an engineer and asking why, I started breaking that, delving into that a bit more. Essentially, the reason was because the heavy industry tends to have lower injury rates than lighter industry, and I'll show that on another slide. And over this period, heavy industry means commodities, oil and so on, the materials and energy companies that had performed better in the share market. So I wouldn't actually like to say that there was cause and effect there. I think there was correlation because of two sort of separate industry dynamics that happened to positively sort of go in the same direction. What I do think, though, is that this data gave a bit of a baseline, and once we understand where injury numbers are for companies, we could more easily see whether somebody stood out from the pack. The next bit of work I did earlier this year was looking at what was going on in the Pilbara, and this was because BHP operations had 5 fatalities in a 10-month period. 3 of those were Leighton contractors, people. The West Australian mining regulator stepped in. BHP did acknowledge that this was having an impact on their iron ore production and has talked about that in various presentations. And I know that some funds represented by AIST were talking to BHP about this, and some of the work helped us background. One of the angles we looked at here was performance of contractors and whether an operation that uses more contractors seemed to have a worse safety record than an operation that did things in-house. We did find that Rio Tinto, who does things in-house more than BHP, tended to have slightly better injury performance, but whether or not one can draw a link is a matter of conjecture and opinion. One thing people are often asking is, well, what's the financial impact of ESG factors? And I worked with our BHP analyst on this and said, well, how much production have they lost? What's the financial impact? And on the back of the envelope, we thought, well, maybe 3 million tons of production. So that might be $120 million off BHP's EBIT. And his following comment was, well, that's not really material to BHP. So, in the context of where one's looking at share price, one does actually have to take into account how do any of these ESG issues fit into the context of the size of the company one's looking at and what it does, because there are all sorts of areas where there might be a particular operation affected by something, but then we have to look at what is the context of that and the likely impact on valuation. I would say that, though, that this and the various media headlines certainly didn't do anything positive for BHP's reputation, but the company is acknowledging that. We then went on to look at safety data, again, across the ASX 100 companies, picking out injury data, lost time injury frequency rate and or total recordable injury frequency rate. I also looked at fatalities. We did this work over a 5-year survey period, looked at all the fatalities we identified within the ASX 100 companies. That was about 200 fatalities, and looking at what happened. Because I think that one can sometimes get carried away with numbers and make judgments about what's likely to have happened. And sometimes when we see the data, we realise that what actually is happening is not necessarily what we would first think. Data consistency, which I'll talk about on another slide, is a huge issue, and that applies for safety, but it also applies to a number of ESG factors, and I'll talk a little more on that. So in the first instance, we collected lost time injury data or the nearest equivalent and tried to normalize the data. The sample here, basically the lowest injury rates are at the bottom of the page and the highest injury rates at the top of the page. You probably can't read all the company names, but what I would say is that heavy industry tends to be at the bottom of the page, and at the top of the page we've got Centennial Coal, which fits with the coal industry statistics in general, and Mirvac, that owns hotels, amongst other things, and Woolworths. We all know what Woolworths' business is. So one might say, why does an organisation like Mirvac or Woolworths seem to have higher injuries than BlueScope Steel or Woodside or Caltex or whatever? Well, it may be, we can draw conjecture from this, but perceived lower risk in some things like hospitality and warehousing and so on. You may get more slips, trips, sprains, falls and things, but you don't risk having 5 million tonnes of sort of hot metal falling on top of you. It may be to do with things like employee turnover, skills and training. It may be a factor of where there are large concentrated sites with a fence around them, and essentially the safety culture, because at BlueScope Steel, I know if you do not do what's in the safety rules, you simply don't work on the site, whether you're a contractor or an employee. I would suspect that, say, younger supervisors in a warehouse dealing with, that's an operation of a supermarket chain, may not have the same sort of culture, systems and so on to implement things quite the same way. One thing I would point out, though, when I say Woolworths is at the top of the list, and should have said before, no other companies in retail reported. And although their number stands out compared with heavy industry, I think from discussions I had with them, and what I did in this research was to talk to companies where their data stood out from the pack. I think Woolworths has got a very proactive safety program that quite likely is better than most retailers. So the sample is a biased sample, and this is on the basis of which companies do or don't report. We can't readily transfer it, I think, to financial impact. One might say, well, an injury costs money. Yes, but does a lost time injury cost the same in a steelworks as in a retail warehouse? And my intuition would be to say, no, they're different amounts depending on how much the people are paid, how much they're trained, all these sorts of things. So I think even Woolworths that self-insures and therefore charges each division workers' comp sort of internally, says that they find it difficult to actually, within their own figures, correlate better safety with a lower workers' comp charge for the division. So as an outsider, I think if we did try to cut that sort of correlation, we'd probably be pushing the boundaries of the information. Lost time doesn't necessarily reflect the approach to process risk, and it might mask big issues. It might cause a false sense of complacency. And the biggest, most obvious example of this that I've come across was BP's Texas City refinery that essentially had a major explosion in 2005. There were a variety of reports into this by the US Chemical Safety Board and also the Baker Review by ex-Secretary of State James Baker. That review was into BP's safety culture and processes and so on, and was extremely damning, but was written in a way that it was intending to be a learnings for industry. And one of the observations was the company was sort of lulled into a false sense of security by focusing on personal injury rate and not looking appropriately at process risk. Effectively, where you've got a plant where if some small amount of fluid of something escapes and the thing can blow up, which effectively was what happened at Texas City, you have to have a certain attitude to how you look after your plant, and cost-cutting, culture, sort of equipment that wasn't working properly and so on, all contributed, and there's a lot of material written on that. So injury rates, injury data, this sort of thing is just one slant on safety, but it certainly doesn't tell you everything. What I did as part of this study was to look at what the fatalities had been in these companies over this period, came up with 200 fatalities, most of them in mining, materials, energy, engineering, construction. There is some double counting because a company might report what happens on its site, but some might be contractors that are reported somewhere else. A variety of reasons. Vehicle accidents were common both on public roads and on private property. Helicopters contributed to quite a number of BHP and Rio fatalities, one incident each. Falls from height, falling objects, rockfall, electrical accidents, lightning, cyclone, landslip, some unsafe equipment or unsafe environment. Sometimes companies were found guilty of not providing a safe environment. Sometimes employees not following procedures, and that then would come back to culture and where can you influence employee behaviour? Where might the perhaps be a point beyond which one might think the employer has done all they can. But what we did do was to tabulate what happened for each of those 200 incidents in as far as we could. Now, the data was patchy. Some companies don't report. As I said, the reporting tends to be concentrated in certain sectors. Some include contractors, some include some contractors, subcontractors, others don't. People report different types of metrics. As doing a simple overview, we were looking at company total data, but if we look at a breakdown of a number of companies that have operations, say, in Asia, it's almost miraculous how few injuries there are in Asia. Well, I mean, what this is saying is if one's averaging over a load of different jurisdictions that have different reporting standards, in a sense, it's sort of a bit of a random number generator. So again, we have to be careful what we're actually asking if we're asking for data. Which is a bit of a bee in my bonnet about ESG factors in general, that everything I've looked at, whether it be carbon, water or safety, when I start I think, oh yes, there'll be a data set on that, companies report such and such. The more I learn, the more I realise that the data is not actually often comparable, and we have to know what companies do and how they do it. What the data doesn't tell us about is how companies deal with near misses and how they use that information, what their policies and practices and procedures are, and how they deal with facility integrity and risk of a major incident. So what I felt, having done the report looking at the data, was to get companies to talk about their approach to safety. So we held a safety seminar. And the companies were very enthusiastic about presenting at this, got very positive responses from companies I asked there. We had BlueScope, Woodside, Transfield, Orica, Lend-Lease, Mirvac, and Caltex, and Woolworths would have liked to, but just absolutely couldn't fit their diary. So we covered a range of different industries. We had about 50 people attending, fund managers, super funds, and other companies as well. We got a good turnout from other ASX-listed companies. And I feel we're helping to raise the bar here in the sort of responsible investment community, because the companies actually did want to learn from each other. We learnt that companies have to identify the safety issues that are most relevant to them. A key issue is how they embed safety from the top down, how they learn from near misses, and how they deal with process risk. And in fact, that was something that was addressed by Orica, by Woodside, and by Caltex. And Orica, for example, has taken their board through the findings of the Texas City incident. And that's the sort of thing that I think investors should be asking companies that have these big plants, what does your board want to know about how you're dealing with process risk? Woodside explained that operators at the Northwest Shelf have the right to shut the plant down if they're concerned about safety. Now, as we all know, LNG plants are huge revenue earners and not something that you'd sort of turn off on whim, but Woodside has that as the policy, that it's the operator's decision. Going back a number of years, people would remember perhaps when the Piper Alpha platform blew up in the North Sea, and I was reading some stuff on that, and somewhat incredulously, other oil facilities that were pumping into Piper Alpha, and then the oil was going from there to shore, didn't switch off when they could see things going wrong on Piper Alpha because they hadn't been given instructions to. So, there are sorts of questions that one might ask companies. How do you deal with these sorts of things? What authority do you give operators? So there's a whole range of stuff that goes beyond slips, trips, and falls. The companies, as I said, were very enthusiastic about this, and there's been a lot of spin-off that's behind the scenes. Our clients don't necessarily know all these conversations have been happening, but I've had more requests for these reports on safety from companies than on anything else I've done, albeit that companies were also interested in carbon and water. But this one, a lot of people were interested. One large company said, could they share it with the New Zealand CEO Safety Network? Someone else wanted to share it with their global OH&S network. Someone else wanted to share with employees, other stakeholders like shareholders and customers. One large company said this drives senior executive thinking and helps boards to get perspective. One company's invited me to present next week to their board sustainability committee, and they're interested in reporting, but also how investors are looking at these things. Companies are seeing it as helping them to prepare their annual reports, to benchmark themselves. One company, I named in the report 3 companies that didn't report that I particularly thought ought to, because they're in industries where the is a lot of activity happening, and therefore I thought they ought to. And one of them reported safety statistics for the first time in their August results, which I would claim to have had some influence over, although I know other investors were also asking the same company to report on safety. So I think we're helping to raise the bar there. I think the work does provide some background for engagement. The BHP Leighton note did. The safety seminar does, helps clients to understand what some of the issues are. When I wrote the report on that, I didn't summarise what each of those companies were doing. We deliberately chose companies that have a good story to tell and that we can learn from. And the way I wrote that report was a series of questions that I thought investors could ask other companies to understand how they are dealing with safety, everything from injury through to process and plant safety. So a bit of a tool for engagement rather than saying, oh, well, BlueScope does this well and Woodside does this well and so on. So in conclusion, there may be a link between safety and share price. It may be partly because there's a correlation with good management. There also can be costs associated with disruptions, which may or may not be material, depending on the company and the scale. But there's a lot of subjective assessment, because you can't just take numbers, even reported numbers that look neat, sort of mask a variety of variations and so on. And I think that having investors looking at these things does raise it in the corporate's eyes as well. And certainly we found that corporates are talking to each other. In fact, just last week, one of corporates emailed and asked for copies of all the presentations that companies had given, and then a couple of days later asked for the contact details of one of the presenters. So that's one ASX company wanting to engage with another ASX company on safety. So, if the responsible investment agenda is to raise the bar, this sort of thing helps behind the scenes. I think that our client interest in the ESG research is assisted by the initiative, the ESG Research Australia initiative, and also by the UNPRI, because this is encouraging our clients to value work on a variety of sustainability issues. And also, I note that the super funds themselves are starting to also do what they're asking their fund managers to do and reward some of this work through tagged financial transactions. So that also can happen, and it simply encourages organisations like Citigroup to put the resources into this work. So that's my conclusion, but in questions and so on, I'm happy to talk about climate change and water and carbon as well. And there is a handout at the back of the room for anyone who's interested, which is the front page of various research reports I've done on these ESG-related topics, if anyone would like to see what work is out there. And of course, Citi clients can then ask us for full reports if they like. Thank you.
So what I'm going to do just over the next, say, 15 minutes, so we've got time for questions, is talk to you about more engagement. Elaine's given you lots of context on safety as an issue, but I want to put this within the broader context of engagement. So I'm going to define engagement. I'm going to talk about how investors, both asset owners and asset managers, can undertake engagement and what they can actually look to achieve from that process in the context of this discussion around safety, and make some conclusions. So why are we even talking about engagement in the first place? Principle 2 of the UNPRI very clearly states that signatories will be active owners in the companies in which they invest. Now, clearly, it's Principle 1, that's integrating ESG considerations into investment decision-making processes, that gets by far the most attention. That's the one. It's how do you price this? What's the value add? Show me the correlation. Show me the numbers. Show me the performance. But the PRI is about a much broader set of objectives. The others, which is engagement. Asset owners are certainly ones to undertake engagement because of the permanent nature of their share ownership, particularly of ASX 200 companies. So when you amalgamate up all of the holdings of your underlying active managers, at the end of the day, combined with your index portfolios, you're going to hold the whole ASX 200. So you're all ultimately investors in the whole market, so thereby exposed to every environmental, social and governance risks. And then even for fund managers, if you don't hold something now, you're likely to hold it at some point in the future. So engagement, particularly as it relates to disclosure, is an important thing to undertake to make sure that you're getting the information that you need. The other reason you undertake engagement as an asset owner or manager is just the sheer weight of investment. The Australian superannuation is the 4th largest pool of superannuation anywhere in the world. We have a huge influence over the companies in which we invest to encourage better practices and also to encourage better disclosures. So I would often put out the question that with that sheer weight of investment, is there not an obligation on us as asset owners and asset managers to be active owners in those companies in which we invest and encourage them to manage these long-term issues that are going to impact the performance of their investments? Now, it's a tricky one because fund managers at the end of the day trade governance while asset owners own governance. So there's always going to be slightly different perspectives to the engagement that's undertaken by a fund manager as opposed to the engagement that's undertaken by an asset owner. And I'll explore that a little bit more in terms of the types of engagement. So if you were to split, I tried to sort of split it into 3 categories of the types of engagement. There's what I'd call the direct investor-led engagement, and that's where the asset manager, so the fund manager, engages the underlying company, and it's very much connected to the buy-sell decision. It's connected to the underlying investment decision-making process with the company. So the message the company's getting from the investor tends to be a little bit more short-term and in the time frame of the investment that the fund manager has in the company. The second type of engagement I'd categorise as direct owner-led engagement, and that's where a superannuation fund or asset owner will take it upon themselves to engage a company directly to get a behavioural change or a better form of reporting. And then the third element, a type of engagement I'd call collaborative engagement. And this can be either fund managers collaborating together, asset owners collaborating together, or both asset owners and asset managers collaborating. And this is usually done through agents or different forums. So like the PR, the Principles for Responsible Investment, or it might be done through organisations like ACSI, the Australian Council of Superannuation Investors. The Carbon Disclosure Project is another form of collaborative engagement where both asset owners and asset managers collaboratively ask companies questions on sustainability issues. And then there's other organisations like Hermes and FNC in the UK that undertake engagement, and specific issue-led engagement by groups like the Investor Group on Climate Change and Risk Metrics. But I'd also echo Elaine's point in terms of this broader concept of engagement, that being raising the bar of the whole industry. And I think that's exactly what we are trying to achieve through ESG Research Australia. ESG Research Australia is an initiative, a collaborative initiative between fund managers and asset managers, where there's a commitment to incorporate into the way you reward the sell side a consideration of their deliverables in terms of sustainability or ESG type research. So this is the firm carrot that we as asset owners and asset managers can put out there to the sell side to provide more research. And I think that is another form of engagement. It's not usually classified as engagement, but I think in some ways ends up getting a better outcome and does raise the bar more than us going and bashing companies over the head behind closed doors. So it's something I sort of want to throw out there that doesn't sort of fit in that engagement bucket, but I think gets those outcomes. And as a result, we have Elaine doing the types of research that she's doing. Andrew Gray at Goldman Sachs, JB Weir, has also done some research in safety, looking more for the correlations. And a plug for JP Morgan, who are also going to be holding a safety session on the sell side in the future as well. So we're starting to see, hey, Wilsey, if I'm going to talk about... Yeah, that's all right. I thought I was getting a hard time. So we are getting the, starting to see that change. And I always sort of joke, well, gosh, if, Citigroup or Goldman's or Macquarie or JP Morgan, for goodness sake, are talking about this firmly, it's starting to be mainstream. But coming back to this sort of engagement. So the collaborative engagement that can be done by signatories to the Principles for Responsible Investment can be done through the clearinghouse. Who here is a signatory to the PRI? And who's ever logged on to the clearinghouse? It's okay. It happens all the time. We're at the PRI Global Dialogue here, where there was signatories from all over the country. There was a very similar response in July. So that's why I did a print screen. I'm probably going to get into trouble for doing a print screen. But anyway, you basically can log on. And I was intrigued because I went into the clearinghouse and put in safety to see if there had been any collaborative global engagement on safety with companies, and nothing came up. So I had to take a screen print of something else. But basically what happens, and maybe there's an opportunity here with a number of PRI signatories, and that we've heard clearly from Elaine that there's some gaps in terms of safety in the underlying reporting. There can be some collaborative engagement that can be undertaken. But you can go into this, I call it a little bit of like a Facebook of RI. Who here's got a Facebook account? Okay, maybe there's a correlation here. Maybe there's a correlation here. So it is a little bit like the Facebook of responsible investment, where you could go in and you can start a collaborative engagement issue, and you can invite other investors to join your engagement group, and then you'll jointly approach the company, and there'll be a letter drafted and that kind of thing. So it's quite an effective forum to have global engagement on issues that are a concern to a global group of investors. And this is primarily around disclosure issues at the moment. It's difficult to engage outside of that. Just the other point that I'll make as well is that all of the collaborative engagement that's in here, and all of the collaborative engagement that's discussed, and even direct engagement, is predominantly focused on listed equities. And I would argue that that's also potentially a bit of a gap, because in listed equities, at the end of the day, you are trading governance, you're trading ESG, but in direct infrastructure and property investments, you're stuck with the performance of those assets, and you're stuck with the underlying risks to those assets. Now, something like safety is something that you can clearly look to get some behavioural change on with the companies that you invest in. And I sort of go back and forth. I mean, I don't know, and if I'm confident in this, but I would think that if you own 60% of an asset through an infrastructure portfolio, you would think that you would have a greater level of influence on the management of that asset as it relates to safety than you would if you held less than 1% of a company, say, in a listed equities portfolio. Now, you hear different things from CEOs. They sort of say, well, in an infrastructure type investment, they treat all unit holders equally, and even when they're a listed company CEO, they're just as interested in the 1% holding as they are in the 2 or 3% holding. I mean, I don't know if they're just telling us that because Colonial happens to own 1% of the company, but there's that real opportunity to engage in the unlisted space as well, in the direct infrastructure investments, and also in the direct property investments, where you sort of think property safety, what does that mean? But property in terms of construction and development is clearly a huge gap in terms of safety. I mean, Elaine, would you agree that construction sector was probably a bit of a gap and probably a worse performer on safety?
Because of things to do with accepted work practices and falls from heights and falling objects, and sort of what can be worked out with unions in different places, different countries as well, a whole range of issues.
And I can almost guarantee with a lot of the developments that's going on in our underlying portfolios, the companies that Elaine's been looking at are probably the companies that we're using for those developments. And then with the management of those assets as well, you do use a lot of people in the underlying management of property assets. When you look at our business where we manage our retail, more than half of our workforce is actually in the property management business. It's not in the funds management business. So there's a lot of people there, and the more people would imply that there's an issue, a potential issue around safety. Now, this example of getting better information, how does engagement work in practice? I'll give you a bit of an example of how the way we look at it. For us, it's not, we're sort of more value, bottom-up type managers, where we look at the underlying companies, try to understand their approach to things and get them to improve their performance. And one of the companies we invest in is AGL, and the head of equities for one of our Aussie equities funds, Marty Littler, is passionate about this safety stuff. This is the type of thing where, is this Chatham House, this session? Is there anybody from Investor Daily here or anywhere? No? Okay, good. I'll tell you this story. I probably shouldn't. Anyway, I won't name the company then. But we were, we had, to give you an insight into terms of how passionate this guy is about safety in the companies that he invests in. One of the contracting companies that was involved in some of the fatalities at some of the mining companies where there's been a lot of increase in fatalities across the mining sector, but it has been with a lot of the contractors. Came into a meeting on, a general investor meeting on general investment issues, and one of the, the second or third thing that was raised by our head of equities was safety. And the CEO could not answer the questions and wasn't even actually sure of the number of deaths of contractors from his company that had died on sites for the companies that they work for. He couldn't answer that question. Marty was so angry with him, and the engagement process was so vigorous that the CEO got up and left the room 20 minutes into their hour meeting and didn't come back, and has refused to come back to a meeting since. So it sort of shows you where investors can be very heavy-handed with this and can be very sort of firm in their views. Now, this is not a company that we own, and this is not a company that a head of equities will feel comfortable owning because he doesn't think the quality of management is right. If a CEO of a company doesn't even know how many of his people are dying on the different sites where he's got them deployed, what does that tell you about how he's managing the rest of the business? But there's other examples that are probably not so strong as that, where just the level of reporting and evidence that we were getting on the company's approach to safety wasn't enough. And through the engagement process of meeting with CEOs and executives and doing site visits, the feedback was given to AGL that we thought that they had quite a good approach to safety, and we got that from the site visits that we were doing and from the engagement we had with the company, but we didn't think it had enough prominence in their reporting. Now, an outcome that we got was that slide 1 of the operational review for AGL's presentation in 2009 was all about safety. So all of a sudden you've got a much bigger prominence of an issue that we don't think the company was giving enough attention to in its overall reporting to the market. So it's an example of how engagement with a company, and one extreme is yelling at them until they get up and leave the room and never investing with them. But then if you do own a company where there's potentially just some improvements that can be made, you can work with the company to get better reporting out in the market. But it's not only about reporting, it's about getting behavioural change as well. So Elaine has provided a lot of questions that investors can use, but these are just the ones that we look at when we're engaging the companies and what we try and influence the companies in doing. The first one is, where does safety report to in the organisation? Does it have a level of seniority that we think is adequate, that gives the drive of executives to manage the issues? Now, we don't always know and can't say what's best. I mean, we always sort of thought we wanted to make sure that the board at least got reporting and that the CEO was incentivised as part of his KPIs, and we thought that was best practice. We had this view of what was best practice. But then we met with Virgin Blue the other day, and we're talking to them in trying to get them to come and speak at this conference. I ended up having quite a good conversation with them about safety. It turned out that their safety reporting line was directly to the board, and only the board could fire them. Now, I thought that was a really interesting, I've never come across a company that does that. It's always sort of through the CEO. And the reason that it reported directly to the board was because the board didn't want to have the filtered reporting through the executive team. They wanted to get the reporting directly to them. Now, that was not that was for risk, but that was also for safety and environmental issues. So through engagement and sometimes just listening to what companies are doing and not prescribing a sort of tick a box, this is what's best practice, you can actually find a new best practice or a new approach that's the most appropriate for the companies that you're investing in. But we do look to see if it is linked to KPIs and bonuses of executives, if it's tied to incentive payments, but then we also want to make sure that it's not done in such a way that the companies don't report. So many of us, I'm sure, have worked for organisations that do Gallup surveys. Have you ever seen those, the Gallup surveys, the employee engagement surveys? And do you notice when it's linked into the area's bonus pool or the KPIs, there's sort of these mottos of going around, say 5 to stay alive. Because the more people that say 5 and rate really high on engagement means the bigger the bonus pool going to that particular area. So that's the last thing. Engagement's one thing, but that's the last thing you want in terms of safety reporting, of getting misreporting or underreporting of safety incidents. So we want to try and see how companies manage that balance of linking it into what people are incentivised by, but also making it sure it's not being gamed. But then it's about really understanding how safety fits into the underlying culture of the organisation. What does the CEO say about this? I mean, it's probably not the best example to give, but Mike Hawker used to always talk about the fact that, he was a rugby player and he was pretty tough, and, safety of his own personal being was not something that he thought was that important. But when he started at IAG, he found that IAG had a worse lost time injury frequency rate than BHP. and yet they were one of the biggest insurance providers to the work cover authorities. So he made himself the chief safety officer of the organisation. But it meant he had to start to embrace these safety concepts. And he said the hardest thing for him to stop doing was jaywalking. And the other hardest thing, which I thought was funny, was after jaywalking, was selling his Mercedes and replacing it for a Prius, which he said was just as much for safety reasons as it was for environmental reasons. But it was clearly instilled into the culture of the organisation, and people knew that safety was important. And then similarly, you know, how does it apply to contractors? Are contractors having to meet safety requirements? And how do you train people? So when new people start with the organisation, how are they trained up in terms of the safety requirements for the company? I just want to conclude by saying that engagement is a very important part of the responsible investment proposition, and don't forget about it. What we're seeing in terms of asset owners pushing down to us through the supply chain in terms of what they want to see is that it's very much about integrating ESG into the buy-sell decision. Don't forget about active ownership when you're talking to your underlying managers and you're engaging your overall supply chain. And I think safety is a really great opportunity to see how your investment managers are looking at engagement on issues, because it is really tough to build safety into a buy-sell decision. The numbers don't necessarily translate to a short-term move in the share price, but it does impact the view that you have on management quality. And do you want to have a major position in a company that is a massive, consistent underperformer on safety, and a company that doesn't take safety issues seriously?